Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today's show is brought to you by the Secrets of Successful Syndication. This two-day workshop will unlock the keys to the kingdom in terms of how to take your investing career to the next level. Almost all professional developers use syndication to scale their business. When I talk with deal sponsors, I hear over and over again that access to capital is the number one thing holding them back. It's going to be held on September 25th and 26th. 2 full days of amazing content, and this event is put on by my good friends at the Real Estate Guys radio show. I've been to a lot of events all over the world, and I have to tell you that this event is among the very best in the world. To learn more, go to victorjm.com/events. That's victorjm.com/events. On today's show, we're talking about the latest guidance from the Federal Reserve regarding interest rates. Yesterday, the Fed announced the results of their latest committee meeting. They reaffirmed their guidance on maintaining interest rates low for the next 18 months, and then they extended that guidance by another year until the end of 2023. The Fed talked about the role of monetary policy, which simply means interest rates. The Fed also made it clear that simply lowering interest rates won't do much to further stimulate the economy. Whether interest rates are 2% or 0 isn't all of a sudden going to get people to run out and make new investments. The Fed chairman also spoke about fiscal policy. This is controlled by the Treasury Department spending of money to stimulate the economy. And naturally, the Fed has a hand in this as well because the Treasury is empty. And any spending requires the Treasury to come back to the Fed with cap in hand, asking the Fed to print more money. Right now, political wrangling has created a stalemate where the losers are those who are in need of financial help. The politics of an election have come ahead of helping the crippled economy. After nearly a month with little congressional progress on a renewed package, the economy is in peril from lack of government action. So we have interest rates at historic lows. What do you do with that information? What decisions should you make knowing that interest rates are going to be low for some time to come, perhaps the next 2 to 3 years? As I see it, low interest rates may possibly reduce your income if you're in the business of lending money. But if you rely on debt to fund the growth of your business, then you've got a bunch of decisions to make. Number one, the very best thing you can do in this environment is reprice existing debt into a lower interest rate vehicle with as long a horizon on that debt as possible. When you borrow money in an inflationary environment, you're basically shorting the dollar. You're banking on those future dollars being worth less than today's dollars. If your interest rate is, for example, 2%, and let's say that inflation is running at 3%. I know the Fed is saying it's less than that, but let's imagine for a moment that inflation was running at 3%. Then the debt is being devalued at a faster rate than you're paying in interest. So the money at that point is essentially free. I believe we're at the cusp of free money for that reason. But even more important than shorting the dollar, refinancing the debt into a lower interest rate gives you stronger cash flow. It makes your business more resilient to economic shocks. We're not out of the woods yet with this pandemic and all of the economic side effects. Lowering the cost of your debt is fiscal responsibility. The next thing you can do is it's tempting to go secure additional debt to grow your business. After all, the debt is so cheap, it's tempting to get as much capital as possible to take advantage of the low interest rate environment. But here's where you need to think carefully. What's the purpose of that debt? Is it to provide a cash buffer for the business? If it is, that might be a good thing to do, assuming, of course, you can afford the interest. Or is it to fund growth in the business that's based on verifiable, sustained demand? Or maybe is the growth speculative? In today's environment of uncertainty, you want to be establishing clear criteria for how you make investments. When are you going to make incremental investments? Have you established a high enough bar for making those investment decisions? I have to tell you, I'm bombarded with deals every day. Most of them make no sense at all. And just because debt is cheap, it makes the investment metrics look more attractive, but that's an illusion. If your interest rates go up 3 years from now, how will that investment look then? Will it still meet your criteria? You definitely want to conduct sensitivity analysis to see how it looks in a more expensive interest rate environment. See, all investments are made within a context, and that context makes a number of assumptions. For example, back in 2010, the context was a distressed market where assets could be purchased for 30 to 40 cents on the dollar. Today's context isn't fully known or understood. Would you make an investment in a new project knowing the government would allow companies to fail? Or are you assuming the government will continue to bail out companies, individuals, and banks? And for that reason, my guidance is that new projects need to be undertaken very carefully. New debt should be used to reprice existing debt first and foremost and improve your cash flow. Beyond that, you want to be very patient and get a clear signal where the economy is headed before you make major commitments to large amounts of new debt. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.